Well, welcome to the next segment of OvernightAccountants.com's Realtors and Reducing Taxes course. Of course, we are still on expenses on Schedule C. And as you may tell, this is a pretty long course. We're going to discuss 3 more sections in this part of the course, with 3 more lines on the tax return, starting with repairs and maintenance. And that is line 21 if you're following along with your Schedule C. Now, what we're discussing here, repairs and maintenance, are really the cost to fix and maintain office and equipment. So it's the cost of fix and maintain your office and equipment related to your business. I wanted to make sure you understand that repairs fix. And what that means is it brings them back to a repair, brings an item back to a previous condition. Now, maintenance maintains functional condition. So there's a couple little definitions we need to have here. Repairs fix, maintenance maintains. Not real big distinction there between the two. It's important you understand it. Primarily so we can differentiate between repair, maintenance, and an improvement, which we'll discuss shortly. Fixing a computer, such as removing a virus. We'll go through a bunch of examples here. Fixing a computer, just to make sure that you are tracking, or you aware, we want to have in your mind when you spend your money on something related to your business, that's a deduction. That's a potential deduction. Fixing your copy or other equipment. Repairing home for sale under contract, items that you would expense. So say you do some little maintenance or repair to an office or a property that you have listed, for example, and you make those costs out of your own pocket. That would be a repair maintenance that you could deduct on your tax return, even though it's not really your property. The intent is to help you make money. So there you go. Maintenance contracts, if you have a maintenance contract, that would be a repair maintenance expense if it's not included as part of a rental cost. So if it's incidental to the rental, it's not included. Really, that would be a rent expense, not a repair maintenance. So it's really, we're looking at where to report items on the tax returns. Your repair office that's rented or owned, that would be repair and maintenance, repair for an office that you own or rent. However, if you're repairing a home office, part of your home office, that would be reported again on Form 8829, and that would be a direct or an indirect expense depending on the nature. So watch that part of this course again. Remember, with this course, the cool thing is you own it. You can watch these parts over and over again for years if you need to, as the need arises, to help you minimize your taxes. So if it's related to your home office, goes on Form 8829, home office expense. Auto repairs, however, are reported on line 9. Those are actually part of your auto costs, car and truck expenses. So it's repair and maintenance, but it's related to your auto, line 9. Repair and maintenance related to home office, Form 8829. Now, beware of improvements. I want to make sure you understand the difference. Remember, we talked about repairs and maintenance, defined those. Improvements are a little different. If you're spending over $500 to add value or substantially prolong the life of something, that could be considered an asset, and it may need to be depreciated. Remember, repairs returns the property to the previous functional condition. Maintenance maintains that property. Repairs return it to a previous condition. Improvements, however, make it better than it was before. So let's go through a few examples here, because this can be confusing. Remember, $500, that's kind of like a safe harbor we're using for this course. Adding additional hard drive to a computer, that could be considered an improvement. Replacing a motor in a vehicle, that could be considered an improvement. Replacing carpet versus removing a stain. Removing a stain would be repair or maintenance. It could also be a cleaning expense. Or replacing the carpet, that would be a capital asset that would need to be depreciated. Improvements must be depreciated, as I just mentioned there a moment ago. So that's it for repairs and maintenance. Let's move forward here to supplies. Line 22. If you recall, when we discussed office expenses, a lot of office things you might think are office expenses are not really office expenses. Some of those items are supplies. So this can be a little confusing, but those are reported as supplies. We're going to go over those in this section. Items regularly consumed or used up and replaced in your business is what's really considered a supply, other than cleaning supplies, which is an office expense. So let's move forward. These are often overlooked, but they add up. Remember, even if you don't have a qualifying home office, you can still deduct these items. Ordinary, necessary business expenses related to you making money. making commissions on the sales of real estate. You can deduct those items. So even if you may think they're really related to your home office, you use them at home, these items, if you're using it for your business, can still be deducted regardless of whether you're claiming the home office deduction or not. This also includes letterhead and business cards, which often we would associate as an advertising expense. Magically, they are not. They are supplies, and they are reported or deducted as supplies on your tax return. Toner and ink cartridge would be another example. Don't overlook those. Remember, if you're using for personal and business, you can only deduct the business portion. Now, here's a list. Remember, we have a summary of the PowerPoint slides I'm using in this course. You can print them out. I'm not going to read all those, but we may also have, if we don't have it now, at some point, we will also have a list. I want to go line by line on that tax return and list out all the deductions that can help you as a realtor save money on your taxes. If we don't have that up yet, we will at some point. However, if you print out the PowerPoint, you can see all these items here: light bulbs, calculator, staplers, thumbtacks, backpack, or a case for your computer. Many of these little items add up, so keep those in mind. Now, I don't want you to lose these deductions. So what I want you to do is make sure if you're going to the grocery store or Walmart or wherever you go to purchase supplies, Target or wherever you're going, make sure you separate your personal items from your business and use your business account on all business purchases, and make sure you keep the receipts using the methods that we discussed earlier in this course. Why? Because every $100 deduction will save you somewhere between, on average, between $30 and $45 in tax. There's an explanation point at the end of that. There's a reason. We want you to save money. That's why you're taking the course, and that's why we're presenting this course, to help you. Now, you can generally deduct in the year of purchase also. So these are items you can stock up on these items at the end of the year for the most part. Don't go crazy on it, but you can purchase a lot of these items at the end of the year to use for next year because they're consumables, and they're not going to generally rise to the level of an inventory where you have to keep an inventory. So you can purchase a couple reams of paper at the end of the year, office supplies, stock up on business cards, those sort of things. And that's a last minute deduction, something to help you out, save some money on your tax returns for that year. So these are some items that are not supplies. Publications and magazines are not considered a supply per se. If it's for you, it's going to be an other expense if it's business related. Dues and subscriptions, we would call that. For you, it would be an other expense. If it's an office related to your office lobbies, we discussed in office expenses, that would really be an office expense. Cleaning supplies, as I mentioned a moment ago, those are really not supplies, even though they are cleaning supplies. They are an office expense also. Remember, assets of $500 or more, they need to be depreciated, or they may need to be depreciated if they have a life expectancy of over a year and you're purchasing, they add up to over $500. So keep that in mind. Now be careful here also, because the IRS knows that many items that you're using for business use or claiming a business deduction can also be used for personal use, such as like mixing your office expenses with school supplies that you would purchase for your children. So just be careful that the IRS knows this, and they may look deeper into this, so make sure you have those receipts, segregate the accounts. The receipts will give you an itemizing list of what you purchased, and if you purchase 3 or 4 backpacks that have different cartoon characters on it, it might not be an office expense. However, if they are legitimately for your business, they are deductible. So I just want you to be careful with this and make sure you're segregating those expenses and only deducting what you're entitled to deduct. So that's it for that section. Let's move forward. Line 23, taxes and licenses on your tax return. These are deductible items, and these are really related to taxes imposed by the government and that you have to pay during the course of your business. Example, that would be license required to practice or to be in business. Some other common taxes would be property taxes on business property. Now, this really isn't related to your auto because they're deducted elsewhere on your return under auto, car, and truck expenses. But a lot of jurisdictions now, even for realtors, believe it or not, I've seen it happen in many counties where even if the few items that you have, the local assessor may be requiring you to pay property tax on those items. And if they are items related to your business, they are deductible on your Schedule C. Also a common item, maybe not so much for realtors, but depends on your jurisdiction again, business and occupational tax based on a percentage of revenue generated during the year. Many of your brokers may need to pay this. I'm not sure of your jurisdiction if you have to. You're going to know if you have to or not because you're paying it. But if it's based on a percentage of revenue, that will be a deduction also. Now, also if you have employees, the Employment taxes, the employer's share of taxes, that would be a portion of Social Security and Medicare that you have to match out of your employee's wages. Also unemployment taxes, federal unemployment taxes, and any other taxes that may be in your jurisdiction where you're at. Taxes that you pay, not deductions from the employee's pay, are deductible on your tax return as a tax. Some few notes on sales tax here. I want to make sure you're aware. I've seen so many times where folks that would segregate their sales tax on purchases from the items they purchased and try to deduct on a different line. That's all well and good if you want to do it, but it just makes a mess. You really want to include the sales tax on purchases with the cost of the purchased item. You're not going to deduct it separately as a tax and a license expense. Like as I said a moment ago, so many folks really, they go crazy. They get software or something trying to track their expenses, and they'll go through each receipt and separate sales tax that they paid versus tax. It's not going to help you out with regard to income tax. However, so just want to make sure you include that in the purchase price. So let's say, example, let's say you purchase supplies for $100 and there's 6% tax on it. Your supplies expense is going to be the total there, $106. Let's keep it simple. You purchase a desk for $1,000 and you have to pay $60 tax on it. That means that you purchased that desk for $1,060, and you would now have to depreciate the total amount. And that would also, generally, just to throw it in there, if you purchase a desk, you have to depreciate it. That would also include freight and shipping, and any shipping you had to pay to get it, to put that desk in service. So just sales tax separate. Don't separate out. Include it with the item that you purchased. Okay. Now, licensing fees for real estate license. An annual fee would be deductible. A business license to a state would be deductible. State, county, or city. Franchise fees, if you have to pay that, your broker may have to pay that. You may not, but if you are a broker or if you do, franchise fees paid to the state for business. So if you have a business license or if you're incorporated or an LLC, oftentimes they will call that a franchise fee or a licensing fee that is paid to the state to maintain your LLC status or your corporate status. That would be a deductible as a license or a tax. LLC renewal with a government agency would also be included as an expense, as a tax expense or a license expense. They both go in the same line. Registration fees paid to other states. If you're working in a different state and you have to pay to have a license in that state, that would be a license or a fee. Not deductible on Schedule C. Let's go over a couple of those items. Okay, federal or state income tax from your personal return is not deductible on Schedule C. So federal tax that you pay on your personal return, your 1040, or your state return, income tax you pay based on your income tax return, those are not deductible items on Schedule C. Now, your state tax may be deductible as an itemized deduction on Schedule A, but they are not deductible on your Schedule C. Neither is your self-employment tax, which is FICA, your Social Security and Medicare that you pay on your earnings. That is not deductible on Schedule C, and as we've discussed in earlier sections, that may be one of your largest expenses. Unfortunately, it's not deductible, but all the deductions we talk about in this course will hopefully help you reduce that substantially. So it's a good reason you're taking the course, and we're glad you're here. Half of that amount, however, is deducted on the front of your 1040. So you do get a little bit of a break if you pay $1,000 in self-employment tax on your tax return. 50% of that amount is deducted on the front of your 1040, which in effect reduces your income tax. So you get a little break for it, and often many states will also reduce your state tax. So you do get a little break for the self-employment tax. Now, special taxes or assessments that improve the property. This is going to be very rare for you. Just want to make sure you're aware of it. Let's say, for example, you have an assessment, a tax assessment, that is for a sidewalk in front of your home, or let's say your office rather. That really is not a deduction. What that is you're going to add that to your investment in the property, which would be, we call it your basis. But it's not an expense, it's added to the basis in the property, and therefore if you literally have your own office, which again is probably rare for many realtors, it will be depreciated over the life of the asset, depending on the type of asset it is. So, okay, notes on taxes and licenses. Home office taxes and fees are reported on Form 8829. as we discussed many times, is related to your home office. It's going to go to direct or indirect expense on your 8829 form. We have a whole section on that. Go back and revisit it. Fuel tax included with fuel. Of course, that is included as an auto expense, and it's included when you buy the fuel. So you don't have to segregate that out very much. If you're a farmer, you may want to segregate out a certain amount of fuel because you may be able to get a credit if it's not used on a highway. However, that is not the purpose of this course. So we'll make you aware of that. Fees for services such as trash, water, those are really not taxes. So let's say you have a municipal water, you pay a monthly fee based on usage. Those are really deductible on other lines. Let's say you pay for trash removal, there's a fee that's really deductible on other lines. Property tax on your vehicle, that is actually going to be deductible as an actual auto expense if you're claiming actual auto expenses. The remainder may be deductible on Schedule A as a miscellaneous, well, not miscellaneous, as an itemized deduction for under tax section, taxes paid by you. Here's a few items I want you to be aware of. Taxes paid before starting your business may really be considered startup or organizational expenses, which we discussed earlier. So if they're paid before you actually go into business, there may not be a lot of them, but if you do pay before you go into business, they are really not deductible. They may be deductible, but they're really not deductible as tax and licenses, but they may be organizational or startup expenses. So certain government licenses must be amortized. Very, very rare, but I want to make sure you're aware of that anyways. There's very few of you guys probably have a liquor license, a taxi license, or a broadcast license. So, but many of those should be amortized over whatever period that they're, that they apply to. So that's actually it for this section of the course. You did very well. I feel very good. And I hope you're learning a lot. And we will see you in the next section of Schedule C.